Almost every VOO versus SCHD comparison gets it wrong. People argue about dividend yield or growth or which one is safer, but none of that answers the real question. What does your life actually look like after you've held it for decades? See, that's where most investors get blindsided. In this video, I'm comparing VOO and SCHD the way an investor should. I'm taking VOO and SCHD and putting the same $100,000 into each one. No extra money added, just letting the time do its work. We'll look at what each ETF actually holds, how they grow, how much income they pay, and how they behave when markets go up and down. And in the end, I'll show John how one choice ends up adding close to $1 million extra, while the other pays more than $17,000 extra per month in dividends, a difference most people never see coming when they start. To understand why this happens, we need a bit of context first. Money decisions don't happen in isolation. You're making them while prices keep climbing, headlines keep changing, and the future never feels fully settled. That's why putting $100,000 to work feels heavy. It's not just about getting a good return, it's about whether this choice gives you options later and holds up when things don't go perfectly. Some people care most about growth. They're okay watching their balance swing around if it means the money compounds faster over time. Others care more about income. They want cash showing up regularly, even if the portfolio grows at a slower pace. This is where VOO and SCHD split apart. VOO works best if you trust long-term growth and can tune out the noise along the way. SCHD, on the other hand, makes more sense if you value steadiness and seeing real income hit your account. One leans into patience, the other leans into consistency. Problems start when people choose investments that don't match how they behave. They pick what sounds best on paper, then second-guess it when the market tests their nerves. That's usually not a math problem. It's a behavior problem. That's how good strategies fail. Now, before comparing performance numbers, it helps to understand what you're actually buying. VOO and SCHD may both be ETFs, but they're built for very different jobs. That design choice explains why their results drift apart over time. VOO tracks the S&P 500 and holds about 519 of the largest U.S. companies. When the biggest businesses grow, VOO grows with them. There's very little intervention, companies naturally rise and fall, and the fund rarely changes its lineup. VOO is designed to capture broad market growth and let long-term compounding do the work. The companies inside VOO are built to grow. VOO's largest companies reinvest aggressively, expand globally, and prioritize increasing earnings over paying dividends. Their value comes less from cash today and more from what they can become in the future. That shows up in its sector exposure. Technology, communication services, and consumer innovators make up a large portion of the fund. These sectors tend to do well when the economy is expanding, which is why VOO often shines during strong markets. The trade-off is volatility. Growth-heavy sectors react quickly to interest rates and slowdowns, making short-term moves less predictable. SCHD is built with a completely different priority. Instead of covering the whole market, it holds about 102 companies chosen for dividend history, balance sheet strength, and consistency. If a company stops meeting those standards, it gets replaced. The goal isn't maximum exposure, it's dependable income. That shows in the types of businesses SCHD owns. It leans towards established cash-producing companies in areas like consumer staples, healthcare, industrials, and financials. These are businesses people rely on, no matter what's happening in the economy. Earnings tend to be steadier, and dividends stay front and center even during rough periods. That defensive mix changes how the fund behaves. SCHD usually doesn't swing as hard when markets drop, but it also doesn't sprint ahead when markets take off. Speed gets traded for steadiness. And once you understand how differently these ETFs are built, the first place that difference shows up is in the cash they send you. VOO does pay a dividend, but it's not the point of the fund. The yield sits around 1.12%. That income exists because large companies pay dividends, not because VOO is trying to generate cash for you. The dividend has grown over time, roughly 6.04% per year over the last decade, but it starts small. Early on, it barely registers. Most of the return is expected to come from the share price rising, not from the money hitting your account. SCHD takes the opposite approach. Its yield is much higher, around 3.59%, which means income matters from the start. On top of that, dividends have grown faster, about 10.61% per year over the last 10 years. That changes the role that dividends play. They're not a side effect, they are the engine. A meaningful portion of the total return comes from cash being paid out and reinvested along the way. This creates two very different experiences as an investor. With VOO, dividends are easy to ignore for a long time. Progress shows up mainly through a rising balance. With SCHD, dividends are hard to miss. They arrive regularly and make the portfolio feel alive, even during stretches when prices move sideways. What matters is what you want dividends to do for you. Are they a side benefit you reinvest, or the main reason you're investing in the first place? That answer points you toward the ETF that fits your goals. Before you decide which path makes sense, you have to look at what VOO gives up to chase growth. It chooses appreciation over income, and that choice creates a real gap over time. VOO's strength comes from price appreciation. Historically, its annual share price growth has been much higher, averaging 13.92% per year over the past decade. That doesn't mean it rises smoothly. It doesn't. Some years are explosive. Others feel disappointing. But over long stretches, compounding does the work in the background. Gains stack on top of gains, and the size of your portfolio becomes the engine driving future growth. SCHD grows too, just at a slower pace. Its average annual price appreciation has been 9.23%. That's still strong, but the compounding curve is flatter. More of SCHD's total return comes from dividends rather than price movement. Growth is part of the picture, but it isn't the main driver. This gap is easy to brush off early. A few percentage points don't seem like much at first. Year to year, the difference feels manageable. But stretch that out over decades, and the math starts to separate them. Now, in the end, I'll show you how this few percentage difference can result in a portfolio value difference of close to $1 million. Compounding favors the fund that grows faster, and the longer you stay invested, the more noticeable that gap becomes. And to see how that gap shows up in real life, you have to step away from averages and look at actual stretches of time. Short-term returns matter because they shape how investors feel long before long-term compounding finishes its job. When you line up VOO and SCHD across real time frames, the contrast is consistent. Over the last year, VOO returned about 13.6%, while SCHD came in closer to 4.5%. As large cap growth picked up, VOO moved quickly. SCHD stayed positive, but most of its progress came from dividends rather than the share price rising. Stretch that out to 3 years and the gap gets much wider. VOO gained roughly 71.9%, while SCHD returned about 14.7%. This period included a major drawdown in recovery. VOO fell harder during sell-offs, but it recovered faster and pushed to new highs. SCHD absorbed less damage, but its rebound was slower and capped. The same pattern shows up over 5 years. VOO delivered close to 79% compared to about 33% for SCHD. Zoom out to 10 years, and the difference stops looking temporary. VOO's price growth topped 255% over the decade, while SCHD landed closer to 132%. That gap built up across multiple market cycles as earnings expanded and valuations grew. Living through this creates two very different experiences. One portfolio swings more but compounds faster. The other trades upside for steadiness and income. That said, returns only tell half the story. The other half is how an investment behaves when things don't go as planned. This is where the difference between VOO and SCHD becomes very real. VOO tracks the S&P 500, so its risk profile closely follows the overall stock market. When markets are strong, that works beautifully, but when markets fall, VOO falls with them. Its beta sits around 1, meaning it moves almost lockstep with market swings. During major pullbacks, VOO can drop fast and deep, especially because technology and growth stocks make up a large part of the fund. SCHD, on the other hand, moves through stress differently. It holds fewer stocks, focuses on established, dividend-paying companies, and leans toward defensive sectors like consumer staples, healthcare, and energy. The result is lower volatility. SCHD usually doesn't fall as hard during market stress, and its price movements tend to be smoother. Dividends keep coming in even when prices stall or fall, which changes how those periods feel to live through. This doesn't mean SCHD is safe in the sense of never losing value. It still drops during bad markets. The difference is speed and depth. VOO's drawdowns are sharper, while SCHDs are usually shallower and slower. This matters more than people expect. Investors often say they can handle volatility, but real drawdowns test that belief. Some investors panic when portfolios drop quickly, even if long-term returns are strong. Others feel more comfortable seeing a steady income arrive during rough periods. And that brings up another overlooked factor: how easily these ETFs actually trade in market conditions. So performance gets most of the attention, but execution matters just as much, especially when real money is involved. This is where size and liquidity start to separate VOO and SCHD in a very practical way. VOO is massive. It manages around $1.4 trillion, making it one of the largest ETFs in the world. SCHD is still large and well established at roughly $76 billion, but it's operating on very different scales. You feel that difference first in liquidity. VOO trades millions of shares every day with very tight bid-ask spreads. Buying or selling happens fast, and the price you see is usually the price you get. Whether you're putting in a few $1,000s or moving a much larger amount in millions, execution stays smooth and predictable. SCHD trades actively too, but it doesn't have the same depth. For most long-term investors, that won't cause problems, but larger orders can move the price a bit, and spreads tend to widen more when markets get choppy. For long-term holders, this may not matter much. For anyone deploying large sums or rebalancing frequently, it's an important factor. Fund size also reflects how these ETFs are used. Big institutions care about scale and reliability. They need products that can handle large flows without distortion. That's why VOO shows up as a core holding in pensions, endowments, and other large portfolios. It's built to absorb capital without drama. That difference explains a lot about how professionals think about these funds. VOO often forms the foundation, and income-focused strategies like SCHD get added on top. Looking at how institutions behave makes that picture even clearer. Over the last 12 months, VOO attracted about 3,104 institutional buyers compared to 1,786 for SCHD. That gap alone shows how often VOO is used as a default building block. Institutions don't spend much time debating whether they want broad market exposure. They already know they do. VOO is simply how they get it. The flow data backs that up. VOO pulled in roughly $158 billion in institutional inflows while seeing about $22.7 billion in outflows. Even after routine rebalancing and profit-taking, that's still enormous net demand. Quarter by quarter, inflows consistently outweigh outflows, especially during strong market periods. This isn't short-term positioning, it's long-term accumulation. SCHD tells a different story. It brought in about $17.35 billion in inflows, with $4.05 billion flowing out, and far fewer total participants. Last year's quarterly chart shows buying and selling staying more balanced. That lines up with how it's used. SCHD comes into portfolios when income is needed and gets trimmed when capital shifts elsewhere. As for the analyst ratings, the aggregate rating for SCHD sits at 2.49, labeled Hold, based on 563 analyst ratings covering about 77.3% of the portfolio. The price target is flat at $28.90 with no meaningful upside or downside range built in. Expectations here are steady, not aggressive. Now look at short interest. SCHD has about 4.26 million shares sold short out of about 2.62 billion outstanding shares, putting short interest at just 0.16% of float. That short interest ratio is only 0.3 days to cover, and short interest has fallen more than 7% month over month. In plain terms, all of this means very few traders are betting against SCHD, and the ones who do have been backing off. VOO shows the same pattern, just on a much larger scale. Its aggregate analyst rating is 2.86, a moderate buy based on more than 847 analyst ratings covering roughly 51.4% of the portfolio. The price target sits near $633.45, which points to very little short-term upside. Short interest in VOO is also extremely low. About 3.63 million shares are sold short out of 1.34 billion outstanding shares, or roughly 0.27% of float. The short interest ratio is again 0.3 days, and short positions dropped more than 56% month over month. Here's the real takeaway. Analysts may debate upside, but traders aren't positioning for downside. Both ETFs show minimal short pressure, signaling confidence in structure and durability rather than speculation. Okay, before looking at what a $100,000 investment would turn into in a side-by-side comparison between these two ETFs, let's quickly cover fees and efficiency, as they play a very important role. I know, fees are boring, but over decades, they decide who wins. On paper, both of these ETFs are cheap, but cheap and cheapest are not the same thing. VOO charges a total expense ratio of 0.03%, while SCHD comes in at 0.06%. That difference looks tiny. On a $100,000 investment, we're talking about $30 a year versus $60 a year. Easy to ignore. Until you stretch that timeline to 20 or 30 years. VOO's cost advantage comes from how simple it is. It tracks the S&P 500, rebalances mechanically, and doesn't need frequent changes. That's why its management fee is just 0.02%, with total expenses staying extremely low. Less activity means fewer hidden trading costs, less turnover, and less drag on long-term returns. SCHD is still inexpensive, but it's more hands-on. It screens for dividend-paying companies, removes underperformers, and adjusts holdings based on dividend quality. That extra work adds a little more cost. Its total expense ratio of 0.06% is still far below the industry average, but it reflects higher turnover and more frequent rebalancing behind the scenes. This matters because costs don't just reduce returns once, they compound in reverse. Every dollar paid in fees is a dollar that doesn't grow, doesn't compound, and doesn't earn future returns. Over long periods, that gap widens, especially when growth is doing most of the work. Which brings up the next question. Does SCHD's higher income and more attractive approach make up for that added cost? Or does VOO's efficiency keep pushing it further ahead as time stretches out? Let's do a head-to-head comparison and find out. With VOO, the engine is price growth. VOO has a 13.92% annual price appreciation and a 1.12% dividend yield, growing at about 6.04% per year. The portfolio grows fast. Based on these metrics, after 1 year, a $100,000 investment would be valued at $115,040. At the 10-year mark, projections put it around $394,664. By year 20, the portfolio would be worth close to $1.5 million, and after 30 years, projections show a value of roughly $5.59 million. Where that value comes from is the key point. Out of the $5.49 million added over the 30-year period, more than $5.4 million would come from capital appreciation. Dividends play a supporting role, projected to contribute about $80,509 in total over the full timeline. Even after 3 decades, income remains relatively small. Annual dividends are projected at around $5,081 per year, or roughly $423 a month. The portfolio would be doing exactly what it's designed to do, growing in size, not generating cash flow. SCHD projects a very different outcome. Its price growth assumption is lower at 9.23%, but the dividend side is doing all the heavy lifting here. Starting with a 3.59% yield and a 10.61% dividend growth rate, the compounding effect of reinvested income is massive. After 1 year, $100,000 in SCHDs projected to grow to $112,820. At 10 years, projections place it around $340,999. By year 20, it would cross $1.22 million, and at the 30-year mark, the portfolio is projected to finish near $4.63 million. The makeup of that value looks very different. Out of the roughly $4.5 million total portfolio value, about $2.96 million would come from capital appreciation, while roughly $1.5 million would come from reinvested dividends. That leaves SCHD about $950,000 behind VOO in total value. The trade-off shows up in income. After 30 years, SCHD is projected to generate about $215,998 per year, or roughly $18,000 per month. That income is driven by approximately $1.57 million in reinvested dividends compounding over time. So there you have it. If you go the growth route, VOO would add an extra $950,000 to your portfolio over 30 years. If you go with SCHD, it would pay about $18,000 a month in income instead. That's the trade-off: a much larger balance or a steady paycheck. Choose the one that fits how you want your money to work for you. Want to see how a simple dividend portfolio can generate $4,800 a month, starting with as little as $20 a week? Click the video on the screen to see exactly how it's built.